What's up, fellas? Hey, am I in frame? Okay, stock-based compensation in 3 minutes or less. Here we go. We are talking about topic ASC 718, dealing with share-based payments, stock-based compensation, call it like you want. First question, is it employee-based or non-employee? It covers both. The standard covers both. We're going to be talking about employee-based awards because that's a lot more common. First thing you need to ask yourself, is it compensatory or non-compensatory? Most of the time, compensatory. We have to recognize compensation expense for these awards. The exception would be if we're only giving a small discount on our stock to all of our employees. Doesn't usually happen, 5% or less discount. Once we have decided we got a compensatory stock-based compensation arrangement to our employees, we got to ask ourselves, is it equity classified or liability classified? If it's equity classified, that means we don't need to worry about remeasurement. We recognize the employee award over the period in which it's earned. We don't need to remeasure, and it stays in equity. If it's a liability classified award, that means we might have to pay cash or are paying cash. That requires us to remeasure that award, not just to the point where it's been earned, but until the point it's ultimately been settled or paid. Okay, once we figure out classification, now it's grant date fair value that's going to drive our accounting. We've got to figure out what's the value of that award. That's determined on the grant date when we have a mutual understanding between the company and the employee, and at fair value. But be careful, we're not talking about fair value under ASC 820. Although it's very similar, it's not exactly the same because unlike ASC 820, which looks at a market participant perspective of value, we're looking at what we think the behavior of our employees is going to be. So it's a little bit different. Some of the key inputs, if we're doing a stock option model, would be looking at volatility, looking at expected term, as well as some other ones like fair value of the stock, discount rate, strike price, things like that. Once we do that, now we have our grant date fair value that gets recognized over the period in which it's being earned. We call that attribution. We might have service conditions. We might have performance conditions. We might have market conditions. Depending on what they are, that's going to drive the period in which we recognize the award. If it's a service condition, we simply recognize it evenly over that period of service. If it's a performance condition, such as meeting revenue targets or something like that, well, then we would look at whether it's probable to be earned, and then we'd recognize over that period when we think it's going to be earned. Market conditions, be careful with them. Those are awards based on our stock price. That likelihood of meeting the award is baked into this grant date fair value and therefore isn't subject to reversal if the market condition is not met. Some other things to think about. Forfeitures. What happens if people leave before earning that award? We have some options under ASC 718. We can either estimate forfeitures or recognize those forfeitures as they occur. The other thing is private companies. You have some private company alternatives to make life a little bit easier. Look out for them. But I got 3 minutes, so I can't go into detail. And lastly, modifications. That's a whole separate issue that needs another video to be dealt with. Okay, that was stock comp in 3 minutes or less. It's a bigger topic than that. There's so much more to it. But don't worry, we've got you covered. Go to our GAAP Dynamics learning library at our website, gapdynamics.com, where you will find a whole series of courses covering this topic, as well as lots of other accounting topics. So come by and check us out. Stop there, check us out, buy our